Hey everyone, and welcome to our DAT IQ weekly market update. This is our update for Tuesday, May 25th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined by Ned Damon, Principal Data Scientist, and Dean Croak, Principal Industry Analyst. Welcome, guys, and good morning.
Hey, good morning,
Ken. Good morning.
Tell you what, this Northeast heat wave, I'm loving it. Absolutely loving it. Yeah. Gonna get out there, maybe set up the old bird bath and make a fool of myself in front of the neighbors. Nothing unusual for a late May weekend. Any plans for Memorial Day?
I'm vaccinated and my dad friends are vaccinated, so we're all going to get the lads together in a backyard and do some grilling.
Same here. We've got our Massachusetts lifts the mask mandate this week, so it's nice. No masks anywhere, and we've got about 70% of the adult population vaccinated completely, which is pretty good. So everybody's ready to party this weekend.
That's awesome. Yeah, Ohio's mask mandate is lifted. Everything's lifted on the 2nd. The first $1 million vaccine lottery starts tomorrow. I think they choose the first winner. So proud to be in Ohio this week. Just as a clerical note, we won't be here next Tuesday. I think everyone will have a little bit of a hangover, figuratively and literally, from the holiday weekend. I'm hopefully spending some time with family for the first time, so we figured we'll take the week off, assuming most of you will as well, and catch you back the week after. But with that, we're here every Tuesday, most Tuesdays, talking freight, 10 a.m. Eastern, 7 a.m. Pacific, trends in the market, but most importantly, answering your questions. The past few weeks, we've been on a roll getting tons and tons of questions, struggling to get to them all in our time period. So if you can get them in early, just drop them in the comment section below or the chat, and our marketing team will get those fed over to us to answer. So with that, I'm going to go to the key points of the week to get the show moving. So heat's coming out of the spot market a bit. We saw activity on our load board come back down for dry vans and reefers. Some mixed messaging, quite frankly, on rates. Rates started the week pretty strong and fell a tiny bit throughout the week. So if you look at a pure week-over-week aggregate, it does show positivity. But if you look at sort of the slope throughout the week, the 7-day week, it does show a bit of pulling back. As you know, the load-to-truck ratios tend to lead pretty consistently lead market changes. So we would expect some softness to continue in spot rates, at least for dry vans and reefers. And this is all just signs of things coming back to normal after that road check week. But looking ahead, there's two more points of reference for DOT inspections throughout the summer. So looks like we're having a bit of a catch-up year, as Dean called it. So with that, I will turn it over to our market expert, Dean, and he'll walk us through our update for the week. Dean?
Yeah, thanks, Ken. Let's have a quick look at it. As Ken mentioned, there was some change in the activity last week. Load post volumes did decrease in the market. In the dry van sector in particular, they were down about 19% week over week. There was more trucks entering the market in the dry van sector. So as a result, the load-to-truck ratio moved down slightly. In the refrigerated sector, there was about a 21% decrease in spot rates also. Could be the tail end of carriers returning to the market. We think that is anecdotally. We talked to some carriers, and that's what it sounded like. Most of the carriers that take time off in road check week are, in fact, refrigerated carriers. The equipment post jumped by 24% week over week. It was about the same drop the week prior, so we think that's just the lag in carriers entering the market. So the load-to-truck ratio dropped to about 9.81. In the flatbed sector, there was almost no change in load post volumes last week, but similar to the dry van and reefer sector, capacity eased. There are about 12% more equipment posts. So again, that lag as carriers return to the market, that pushed the load-to-truck ratio down to 88.04. But of course, as you can see on the chart, tracking almost identically to 2018, despite that year being a very different economy. Having a look at our market condition index, load posts in the top 10 markets dropped slightly last week, but capacity remained relatively flat in the top 10. They represent about 25% of our total volume each week. Average rates in the top 10 were about $260 a mile, excluding fuel surcharge. Memphis was the only market to report higher week-over-week gains in the top 10. with a 3% increase, but as expected, capacity tightened following the extensive delays created by the I-40 bridge. Out in the west, in Los Angeles and Ontario, volumes dropped 8% week over week, but rates increased, not by a lot, only by 1 cent a mile. They're up to 303 and 313 a mile in Ontario. That's excluding fuel. In Atlanta, volumes were down 11%, but capacity was still tight. Rates were up about 3 cents a mile. And for the second week in a row, rates on the Atlanta-Philly lane were up last week to $291 a mile. $328 a mile. They're up from $291 a mile since last July. In the refrigerated sector, top 10 market volumes decreased slightly, but spot rates increased by about 1 cent a mile for an average in the top 10 of $295. Volumes in Atlanta were down 15% week over week, but capacity eased slightly. Rates dropped 6 cents a mile to $301 in the refrigerated sector. As expected, May is sort of the end of the produce season in Florida. Capacity loosened in Lakeland. Rates dropped 3 cents a mile to $249, while further south in Miami, volumes dropped 7% week over week, and spot rates plunged 13 cents a mile to $256, signaling the end of the high volumes in May for produce. And out on the west coast in Fresno, volumes declined 7%, but capacities are really tight on the west coast. Rates were up around $325 a mile after increasing 7 cents a mile last week. And in the flatbed, rates increased 3 cents a mile in the top 10 markets. They're averaging $354 a mile, excluding fuel. A lot of those volumes are coming out of the sort of the south, mid-south region. Volumes were up slightly. The I-40 bridge seems to be having some effect in Memphis. Outbound load post volumes in Memphis dropped 23% week over week. That's a significant drop in flatbed volumes. But outbound rates spiked 21%, 21 cents a mile to an average of $371. So we suspect a little bit of congestion is causing some difficulty in the freight networks there. Having a look at the year-over-year spot rate review, dry van spot rates were up 3 cents to $240 by the end of the week. And for context, spot rates, as you can see on the chart, they're about 93 cents a mile higher than this time last year, but more importantly, 55 cents a mile higher than the same week in 2018. Reefer rates were up a few cents to $277, still very high and at record levels, 89 cents a mile higher than this time last year, and about 54 cents a mile higher than this time in 18. And lastly, with flatbed, flatbed spot rates have been on the rise for 106 days as of today, and that rise began on February 9. They were $220 a mile back then. They've increased 54 cents a mile since then. And of course, they were accelerated by the late Feb polar vortex event. Last week's spot rates were $274 a mile, about $1 a mile higher than the same week last year, and about 30 cents a mile higher than the same week in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in the freight market, go to dat.com/market update and download our weekly report. So that's it. Over to you, Ned, for the short-term forecast.
Well, if you like rates going up and model agreement, that's what you're going to be seeing a lot of this week. So we're going to begin with our dry van forecast. In blue, you can see the market rate observed by DAT. And then off to the right, it's very difficult, but you can, if you have very sharp eyes, distinguish that there are a couple of different models that are all predicting the same thing. The short-term model in red, our flagship model rate cast in green, and blended forecast in gold and silver, which are mixtures of the two in different amounts and in different ways. And all of them are pointing up and to the right, slowly but surely heading into the middle of June. Moving on next to reefer. Once again, you can see in blue the market rates observed by DAT. And then again off to the right, broad model agreement up and to the right, the short term in red, rate cast, our flagship model in green, and the blended forecast in gold and silver, all saying the exact same thing, which is up and to the right, heading into with a slightly reduced slope, but still pretty continuous trend through to the middle of June. Finally, we're moving on to flatbed, and wouldn't you know it, the actual market rates observed by DAT are in blue. The short-term model is in red. Ratecast, our flagship model, is in green, and the blended forecasts are in gold and silver. And here you don't have to quite be a wizard to be able to distinguish the models, but it helps. And if you look, you can see that there's a little bit of disagreement on this projected slope going forward, with Ratecast being a little bit more bearish and expecting the rate of change to slow down slightly heading into the later part of May, but then basically to pick back up and be in line with the short-term forecast, which is saying up and to the right through to the middle of June. So the consensus forecast on everything at this point is basically up and to the right until the middle of June. And that will bring us to our IQ question of the week, which is a little bit different. Will we see a second half fall off in flatbed rates similar to 2018?
Before we turn it over to Dean, I figured I'd give him a little bit of a break this week. It should be called Ask Dean. This should be the segment. Just a level set for those who maybe don't have as good of a memory. Earlier in the show, we showed flatbed, and it's quite remarkable, right? The first 180 some days of the year in 18, it was literally a stair step upwards for flatbed rates, and then almost a mirror image downward in the second 180 some days of the year, which is really a remarkable trend. And we've been talking a lot about how so far in 2021, flatbeds have been moving directionally the same, albeit at a higher level as 2018, which really brought about this question of what is lurking on the other side of the 4th of July. And so with that, I will turn it over to Ask Dean to give us some perspective.
Yeah, it's a great question. I've been perplexed all year about how similar both economies have been in terms of how it reflects in our data. 18 was, of course, an industrial-driven economy, a lot of flatbed volume. Spot rates in flatbed were higher than contract nearly all of that year. I did notice that spot rates started to turn about June, and it's maybe it's more than coincidental that we're starting to see something similar, certainly on the demand side. And I think the answer to the question is they could track identically in terms of the downslope for the rest of the year. And I say that because on a recent podcast with Stinson Dean, who's the founder of Beacon Trading, he made a statement that caught my attention. He said high prices cure high prices. And of course, immediately following that, the data from the Census Bureau in April showed a 13% drop in single-family housing starts in April. That's the first time they've gone down in the last 14 months. Single-family permits, which lead housing starts, they were down 4%. Anecdotally, some of the builders that the National Association of Home Builders talk to say that they're slowing production down in order to deal with skyrocketing prices and a shortage of labour and land. So there's definitely a decrease in activity. Builders are also putting in escalation prices to deal with high lumber prices and commodity prices for things like copper. But for perspective, we still built nearly 400,000 more homes than April last year. So we've still got a lot of activity, but it certainly looks like there's some headwinds down the road if, in fact, high prices do cure high prices and we start to see the heat go out of the housing market, which, of course, has driven a lot of the volume in the flatbed market in the last year.
It's bizarre, right? So if you think, I don't want to step on you now. I just don't want to lose this thought. I'm getting old.
No.
Another year has elapsed. But if you look at like three, there's a handful of kind of subsectors that really drive flatbed, and three of those are on fire right now. If you think of like the oil and energy, kind of heavy manufacturing and industrials, and then building materials. I mean, all three of those industries are steel prices are through the roof. Mm-hmm. Lumber prices, I just saw yesterday, it was in a Fortune article, up like 323% year over year. That's just wild. I mean, it's just absolutely wild to consider the price of what you're hauling being up threefold over where it was last year when it was already high.
Yeah.
So
flatbed carriers will tell you that there's, the products they're hauling, like a guy I spoke to on Saturday unloading bagged cement. The sort of the Redicrete type product. There's a shortage of cement, it turns out, bagged cement, because people are building things at home. And of course, we're heading into that peak season. He said they can't get enough trucks to haul cement to building supply outlets for commercial builders. And
they're choosing to use it in bulk too. I mean, if they have a choice of whether they're going to go pour it on site and pour hundreds or thousands of yards of it versus bag it up and ship it to Lowe's or Home Depot. I mean, it's not even a choice, right? And you know what you're going to do. What were you going to say, Ned? I feel like we're now at this point 2 or 3 minutes past the comment you were going to make.
I would say that it is kind of uncanny, but another thing that needs to be addressed is the fact that there's going to be that brake check and that road enforcement that's coming up. And I know that flatbed carriers get to be a lot choosier. And given the way that the capacity situation has been, like, what used to be very short-term blips have given themselves a little bit of legs, as we've seen with Road Check Week that happened just a little bit ago.
Mm-hmm. Yep.
And we're coming up on tropical season too, right? I mean, I think we just had the first named. Did it actually get named in the Atlantic? Anna, was it? Anna? Anyone?
Not sure.
I thought I was on a long weekend fishing trip this past weekend, so maybe I dreamt that up. But I thought we saw the first named tropical depression storm thing, but maybe not. But again, that's going to put upward pressure on fuel, which is already very high. It's going to put potential cramps on capacity and drive up demand for, what gets destroyed when a hurricane wipes through? Sticks and bricks.
Yep.
So, it's going to be an interesting summer.
And you can think back, Ken, to 18, like the catalyst for the rate rise sort of early January was the 2 Cat 5 hurricanes in late 2017. There's a massive rebuilding effort, especially from that second one, which was a big wind event. And I think it was across the Gulf Shores, if my memory serves me correctly. I could be wrong. But one of them was a major wind event, which, of course, requires a lot of dimension frame lumber to rebuild.
It was Harvey and Irma, right? So Harvey basically flooded Houston.
Yep.
And then Irma was the big wind event in Florida. So,
right. Yep.
Fun fact, we used Harvey and Irma to help calibrate MCI.
Yeah, I mean, there are some awesome visuals that we can kind of dust off, pull out of the old Foot Locker and dust off to show if anyone's interested, because you can see how Harvey just kind of stalled and then moved up, and the consequent changes in MCI. It's really, really interesting.
Ken, the other thing though, not just on the demand side, but I think the supply side, there is it's hard to find drivers, it's hard to find trucks right now. Most shippers are looking for growth projections from their carriers, and carriers are trying to figure out how they seat all these trucks. But the flow-on effect is that flatbed's a much harder job. So in a tight labour market, if you're a new entrant to the industry, and if you've got the choice of a flatbed business, which requires more experience and more physical work versus a dry van or a reefer, it's a relatively easy choice for new entrants. So there's already some inbuilt hurdles for bringing drivers into the flatbed business. They're facing a lot harder road in terms of adding capacity on the driver side.
Yeah, I mean, I wonder too, data that they don't really break it out, at least not that I've seen. I wonder what kind of share of trailers are getting built, that are flatbed and reefer dry van and reefer versus flatbed, right? I have to imagine, if I had to postulate, that most of the stuff that's getting built from a trailer perspective now would be dry vans, just to kind of catch up with the huge demand for drop and hook and trailer pools.
Yep.
So it's going to be interesting. So I guess that we didn't really we talked a lot, but maybe we'll go around the horn, because I think personally, I think we might see some contraction on flatbed rates after the 4th of July, but if oil prices remain high, if we continue to see the strong demand for building materials, and heck, once the industrial economy really starts to throw the doors back open, I don't see a ton of deflationary pressure coming in the second half. But what do you think?
I'm going to agree with you, Ken. I don't see much deflationary indicators at all for the rest of the year. I think it's going to affect all equipment types, and that's the tight labour supply. Every industry is going to struggle to try and bring people back on full time and get people back to work in the next 3 to 4 months. That's going to take time to ramp up. So I think the biggest headwind is going to be finding drivers, and that's just going to keep capacity tight and put upward pressure on spot rates. And of course, we've got everybody opening up, and that should relax the social distancing that's been crimping production lines, because nearly every company you talk to has had troubles trying to push product out the door with all of the restrictions in place. So we could see a pretty big escalation in volume this year as everybody plays catch up.
Yeah, but I mean, you drive down the road and you go 10 miles, you'll see 20 for hire signs, or help wanted, or help desperately needed signs, right? I mean, one of the biggest kind of attraction sites close to my house is Cedar Point Amusement Park, and they're going to be on limited hours and days in June because they don't have people to work.
Right.
And that's outdoors, and that's usually a very sought after job for college kids and even high school kids. So I'm concerned in that $10 to $25 an hour tranche, which is a lot of these kind of frontline service and even lower level manufacturing jobs, that it's not just getting truckers in seats, it's going to be getting people working assembly lines and doing that kind of stuff that I think could greatly suffer in the second half of the year.
Yep. Yeah, and they're disproportionately been affected by the pandemic, of course, in terms of having, there's lower vaccination rates. They're still dealing with childcare issues.
Yeah.
So I think that's going to definitely slow down some of the pent up demand. It's a familiar story in restaurants all over the country right now.
For sure. All right, are you back, Ned?
I feel like I'm back. If I'm choppy, then just skip over me.
And his relentless dedication to providing outstanding data science products to our customers. He was actually training a massive data science model while we were on air. So it's not like he was streaming reruns of the PGA Championship. I just want to call that out, that data science never sleeps when it comes to Ned Damon. Do you want me to work on the questions, Ned?
Yes, please.
All right. So I apologize. I won't be looking at camera. I'll be reading questions. But Robert asked, should we expect to see a snapback in load to truck ratio this week with the upcoming long holiday weekend? So I'll turn it over to Dean in a minute, but just to kind of level set on chronology, we'll be talking about next week, even though we won't be here, right? The load to truck ratios we'll be reporting will be this week, which is essentially like the last freight week of the month. So to turn it over to Dean to answer the question, but just a level set, the holiday impact will be the decreased holiday impact we would project to be next week by losing Monday and perhaps half of Tuesday. But go ahead, Dean.
It's actually really difficult to say because this is the last full shipping week of the month. So you'll see more volumes as shippers clear docks. You'll also have a decrease in capacity because you've only got a 4-day work week for carriers next week. So I think the data that we're looking at this week should show the load to truck ratio it'll probably go up a little bit, I think, based on the higher volumes towards end of month, and then come back down again next week, which we'll be reporting on the week after.
Yeah. It's a very weird May, right? 5 weekends. 5 like pretty much full weekends, right? Memorial Days late, and I know there's the joke, right? There's 31 days in every May. I get that. I'm just saying the way that in freight, if you're not familiar with we used to spend an inordinate amount of time looking at how dates and weekends and quarter ends and holidays, especially like the weird holidays like Easter, how they fell, because that could have a really big impact on operations and rates and things like that. And I think this could be a year where I think this week could come in really strong from a volume perspective, and then next week could consequently fall off.
Yeah.
Again, I'm not as experienced with this. Hey, thanks for the shout out, Learn Dispatch today. I really appreciate it. Again, we love dispatchers. I'd be fully supportive of a National Dispatcher Day because I think, rightly so, truckers have gotten a ton of credit over the past year and a half. They've been doing an amazing job, but maybe not behind every trucker, that would be inefficient. But underpinning a lot of those operations is a dispatcher that's working to make sure those wheels are turning and people are getting home, and maybe guiding them through a really tricky address that's not immediately obvious of where they need to go. And maybe you pull up and the guard shack's empty and that dispatcher goes above and beyond to call and locate someone. So those are the things that happen day in and day out that just, they're essentially the WD-40 of the freight world. And pretty much nothing would happen without a really great dispatcher. So yeah, for sure. Matt asks, do you have any new revised thoughts around when Class 8 truck orders are going to hit? Dean, do you want to tee off with that? Because I'm going to look up a quick data point while maybe you're covering it.
Yeah, sure. There was I think ACT Research put out some data last week on the projections, and they were certainly optimistic that some of the Class 8 truck orders from that big bump we had last November, December would start to come out in the latter part of this year. Some of the other reports we've seen, the build times are out in the 12 to 15 months range. So that puts those trucks that are being ordered, say, at the start of this year into Q2 of 22. So I'm not sure. My sense is that the last part of this year is a little bit optimistic given all of the supply chain challenges with semiconductor chips. That's the headwind they're facing there. So to the extent they deal with that, that could be a factor. But they've also got to find drivers. So when the driver shortage starts to ease and we start to get rid of the 2 to 4 month delay in getting drivers licensed at the local DMV, then we should start to see capacity come back in, because on the supply side, there's two things going on. One is the driver shortage and the bottlenecks in getting drivers through training schools in the larger fleets, and then also getting equipment off production lines for those drivers to seat.
Yeah, I mean, we have the chip and the resin issue. We're seeing, I think, last I heard, some easing up on some of the resins and plastics and foams that were holding up some production, and that's kind of, I think, more to play in consumer vehicles. I haven't seen that much relenting in the chip side, as evidenced by some of those long. Normally it's what 7 to 9 months build lead time, Dean.
Normally, yep.
And if kind of to unpack what you said, we're going to see delivery of that late Q3, early Q4 2020 orders. I don't know that we'll see. I'm actually quite confident we won't see very many of these Q1 2021 orders hit in 2021, unless something radically changes or we see like an immense catch up by the OEMs. Right. What we don't know, and I don't think it's anything we've ever experienced, is these units that they've built that just need the chips and some of the other parts to get out the door, how fast they can move that through once they get the parts that are required. So you might see a kind of an expedited, that's a word, expedited catch up of the deliveries. But again, you're probably looking more Q1 2022. Mm-hmm. And then to compound the issue, you're talking about getting drivers in those trucks. I know some of them will be replacements, but there's still going to be net new ads that are going to need seated and driving schools and all of that. Yep, we'll be here all day if we really get into all that. But all right, so Brian and Dave with similar questions. Rates out of New Jersey and PA and Maryland. Fuel's $4 already. Wow. We've built some new tools around how to explore, what rates look like outbound in certain markets. But I haven't noticed any specific upward pressure coming out of those markets recently. I mean, it's been elevated. We've been talking about you're probably seeing some artifacts of even long haul drayage, if that even makes sense, out of Port of Baltimore or Newark area. Have you been seeing anything specific, Dean?
Only on the reefer side, in particular out of New Jersey and Maryland, where you've got produce seasons starting to come online there. A lot of that capacity is sort of more in the southern Georgia area now, where there's a lot of volume coming out of there. So that's forcing up rates in those areas to the north that need reefers.
Yeah, we'll take an eye. We'll keep an eye on it if you're specifically interested. Let me just pull. What was one of the markets? Let me pull Elizabeth, New Jersey, real quick. And I know this is it makes for great television, but I have it. I might as well use it. Where is Elizabeth, New Jersey? Let me guess, New Jersey. Okay, so that'll run, and maybe we'll circle back to it. Bobby asked, when do you expect flatbed rates? How long do we expect it to hold these rates? We kind of addressed that with our IQ question. Anything else to add, Dean?
No, I think it's going to be, there'll be upward pressure there for a little while yet.
Yeah, so I pulled Elizabeth, New Jersey. I mean, if you're looking in Michigan, kind of the two primary Michigan markets, you're still at 203 to 208 over the last week. Chicago, those markets, $1.83 to $1.86. Indianapolis, $1.90. Getting back to Texas, you're starting to get in the longer haul, lower rates there. You're in the $1.50 to $1.60 range. And then if you were so inclined to go all the way to LA or Ontario, you're barely squeaking out $1.10, $1.15 plus fuel at the moment. And that's for dry van. If I flip it to reefer, we can take a peek at that in a second. So we've built out some of these new cool visuals. You can hit us up on LinkedIn or through Ask IQ if you want us to run something specific for you. We can even look at lane balance type stuff. Hey, no shocker, Dean was correct. If you're looking at reefers, 210 or 250, anywhere from 210 to 250 going up into Michigan, 250 to Indy, 210 to Chicago, and then you're breaking $1.25 going all the way out west, all the way up to some of those being $1.30, $1.35. So definitely hotter for reefers right now, as Dean alluded to.
Yep.
Anything else?
That's all the questions, I think.
I think that's it.
Yep.
Hey, we were efficient today.
Right on time.
Right on time. So we're toying with some new visualization ideas. One thing I wanted to put out as a call for at the end of the show, if there's anything cool that you guys would like to look at, I don't have as much time as I'd like to sit around and think of these ideas, because usually once I post something on LinkedIn or Dean posts something, there's hundreds of comments and interactions, and it usually takes us down a rabbit hole and we find something or a handful of cool things. If there's something you want to take a peek at or kind of a visual you wish you had or a look or a view or a report, shoot us a note to Ask IQ. Reach out to us on LinkedIn or directly if you have our email addresses. Because it really helps cut down on some of the ideation time, and we can usually just build it. One cool idea we had was show me like the next market. So if I'm going Fort Worth to Chicago, what are the top 25 markets out of Chicago with rates right now, so that I can kind of make that decision. I'm on a lane, I'm going somewhere, what's next? So we're toying with that idea, and hopefully we'll get that built and kind of prototyped out there to share with you all in the next week or so. But with that, I'm going to wrap up our show this week. Highly recommend checking out the Freight Find podcast. Dean's written weekly market update will be available on our website. Are you going to be doing one next week, Dean?
Yep, sure will.
All right. So if you really are in withdrawal from not seeing our faces and hearing us talk next week, you'll have the full written update to fall back on that Dean will be producing. And then we will be back. I struggle to think what that date even would be. Is that the 8th? Whatever that, Tuesday after Memorial Day will be. We'll be back to talk to y'all. But again, any questions, feel free to send them our way. And we hope you have a great rest of your week and a really great holiday weekend. Bye, everyone.
Thank you.